Hi there, welcome to Kneppy Invest. In recent videos, I have been discussing the topic of trying to find and discover what the quality of a company is when you are researching that company. And for me and my investing style, it is quite important to understand and differentiate the quality of a company. Is it high quality or is it low quality company? And the reason it is important for me and my investing style is because I treat high quality companies a little bit different than low quality companies. So in this video today, I'm going to go through how I differentiate companies from being high quality or low quality and how I treat high quality companies different from low quality companies. So this is a slide I've been using in recent videos. So we start with every single company, and every single company could be high or low quality. And then you try to understand using different factors whether that company is high or low quality. And for me and my investing style, if I find a company is fairly high quality, I will treat that company quite a bit different than if I realize a company is very low quality. For instance, for a high quality company, it's all about value, while for a low quality company, it's all about trend and sentiment. Now, how do I determine whether a company is high quality or low quality? So I have quite a few factors I do go through when I am researching a company, and quite of these factors I already know when I start researching the company. So the first one, and a fairly important one, is whether a company has a moat or competitive advantage. Now, a company can build a moat and competitive advantage over time, particularly when you're talking about something like a brand. A brand increases, or brand awareness can increase over time. And a perfect example of that is, say, Apple. If you go back 20 or 30 years ago, the Apple brand wasn't as powerful as it is now. Now, I do prefer to look at numbers to determine whether a company is high quality. And some of these are quite subjective. Now, with a moat or competitive advantage, this can be subjective. So what I like to look at is gross margins. If you see gross margins falling, that could be a sign that a company doesn't have a moat or competitive advantage, or they're losing their competitive advantage. Or if gross margins are increasing through time, that could be a sign that a company is developing a moat or increasing their competitive advantage. And that's particularly true for companies with a brand. So if you just think of a company that is building their brand, they should be increasing their gross margins over time as more and more people become aware of their product and just love their product. I think a good example of a company increasing their competitive advantage or their moat or their brand is Breville. Another thing I'm looking for is consistent, reliable growth, particularly looking at revenue and profit over time. Now, the growth in profit and revenue doesn't have to be going up in a straight line, but I don't want to see lumpiness there, because if there is lumpiness, or if the revenue or profits of a company are affected by any sort of cycle, hello, mining companies, that means that company is more likely to be low quality than high quality. And I actually do consider the majority of mining companies to be low quality, not high quality. That doesn't mean I won't buy mining companies, but I tend to treat those companies a little bit different from high quality companies. Another thing I'm looking for is whether a company is a price maker or a price taker. For instance, mining companies tend to be price takers because the commodity they're selling, they have no say in how much they sell that commodity. It's all about market demand and market supply. And for a high quality company, for example, Apple, they probably could sell their iPhones for $1,000 more, and a lot of people would still buy them. So they are a price maker. Another thing I'm looking for is low debt. I don't like debt. I don't like debt at all. Now, a little bit of debt is okay, but whenever I see a company with a massive amount of debt, I tend to call that company low quality instead of high quality. And I do think debt is more of a subjective thing. And just for me and my investing style, I consider low debt to be a sign that a company is lower quality than higher quality. Another thing I look for is management, particularly how they deal with capital allocation. And this is probably the most subjective item on this list, because what I consider great capital allocation, another investor might consider poor capital allocation. For example, dividends. If a company pays out 100% of their cash flow, free cash flow, out in dividends, in my opinion, that is bad capital allocation or we'll call it bad capital allocation. Someone else might consider that great capital allocation. So again, this is quite subjective, but I will look at how a company deals with their free cash flow and their profit. Another thing a lot of investors will look at in determining whether a company is high or low quality is financial metrics, in particular return on equity and the rate of invested capital, return on invested, not rate, return on invested capital. I tend to not really focus on these financial metrics, but I do know there are quite a few investing groups, for instance, InvestSmart, really focus on high return on equity companies. So I will look at return on equity. I will look at return on invested capital, but I won't really spend as much time on these financial metrics as I will look at, say, growth in revenue, growth in profits, whether gross margins are rising or falling, whether a company is price making or a price maker or a price taker. When I first start researching a company, I know fairly quickly whether a company is either a low quality or high quality company, particularly if I know what sector that company is in. For instance, the majority, if not every single mining company on the planet, is a low quality company. Now, the low quality spectrum is quite large. So at the lower end of the low quality sort of spectrum, we have those small exploring companies that more than likely, 99.9% chance, they will never get into production. They will never sell a single commodity in the future. But at the higher end of the low quality spectrum, we have BHP, one of the largest mining companies in the world. They have significant amount of revenue, significant amount of cash flow. They issue dividends. But again, every single mining company is a price taker. For instance, if iron ore fell from $80 to $10 a ton overnight, the share price of BHP will drop significantly because there is a correlation between the share price of a mining company and the underlying commodity they are selling. There's almost, I wouldn't say a perfect correlation, but there is a really high correlation between the two. Now, another type of company that I would automatically consider low quality is concept or story stocks. So these type of companies have zero revenue. And again, when I'm looking at high quality companies, they need to have growing revenue or profits over time. And if you have zero revenue right now, it's not growing. So straight away, concept story stocks are low quality. They might have an absolutely brilliant future, but that future is unknown right now. And the majority of concept story stocks never make it. So there's a lot of risk when we're talking about these type of companies. Next type of company that I'll automatically consider low quality is unprofitable or companies with negative cash flow. So again, I want to see profits and revenue growing through time. And the reason why I would consider all these type of companies to be low quality is simply because the way we value company is you look at all the future cash flows of a company and get the present value of all those future cash flows, and that's the valuation. And I need to see some sort of path to profitability. And at this point in time, any company that is unprofitable or has negative cash flow, at this point in time, there might be a path to profitability, but it's a little bit less known. There's a little bit more risk there. So that's why I would consider these companies to be low quality. If a company is moving towards becoming profitable or moving towards becoming cash flow positive, that's when I get a little bit excited about that company, because I might in the next few years, after they sort of hit that really important inflection point of becoming profitable, I might start considering changing that company from being low quality to high quality. And that's an exciting time, because if a company does make that transition from low quality to high quality, you got to see the runway of growth for that company be fairly significant, because not only do you get financial expansion, so increasing profit, increasing cash flow, you also will more likely see multiple expansion, the P ratio of the company increasing, price to operating cash flow of the company increasing. So you have the double whammy, which is a good thing. You have two types of expansion, and that's when you can make a lot of money for these companies that are growing at a fairly good rate. When I say growth, I'm talking about profit and free cash flow. Another type of company that I might consider low quality is microcaps, but I do have a question mark here. Now, when I'm talking about microcaps, I'm talking about those sort of companies with a really low market cap, say less than $50 million. The definition of microcaps is fairly fluid in my opinion, and is fairly um, up to the individual investor. But if I'm looking at a company with a market cap of say $30 million, I would consider that microcap. But I think there is a possibility that some microcaps might be more towards a higher quality end than the low quality end. So at this point in time, I have no absolute opinion on microcaps. And another type of companies that have not a real absolute opinion on is companies with really low margins. And the main reason I'm doubting this is because of Costco. Costco has really low margins, but I probably would consider Costco to be a high quality company simply because their competitive advantage and their moat is their low margins. To further reinforce that mining companies are price takers, and the share price of the majority of mining companies is quite correlated or highly correlated to the underlying commodity price. This is looking or comparing the share price of BHP to the price of iron ore since 2010. And there is without doubt, there is a high correlation here. For instance, between 2011 and 2016, when iron ore prices fell quite significantly, we saw BHP share price fall quite considerably, and the share price of BHP in 2016, start of 2016, fell all the way down to $14. And then all of a sudden, iron ore prices started to rise. And lo and behold, BHP share price started to rise. And it kept on rising up until a few years ago when iron ore prices reached $220 a ton. And the peak in iron ore prices coincides exactly with the peak in BHP share price. That is not a coincidence. That's because BHP is a price taker and their share price is highly correlated to the price of iron ore. Now onto how I treat, or definitely treat, high quality companies to low quality companies. So with high quality companies, it's all about value. For low quality companies, it's all about trend or sentiment. So let's have a first look at how I treat high quality companies and what exactly I am looking for. Now, this is the process I go through when I realize and understand that a company is high quality. The first thing I want to know is the market cap or the enterprise value of the company. So I want to know valuation. Also, I want to see whether a company has profit or revenue growth over a 10-year period. Now, this does not mean I won't buy into IPOs, because I want to see at least a 3-year period of profit or revenue. And when a company does IPO, at least in their prospectus, not prospectus, but when they do list on the ASX, they will provide about 2 or 3 years of financial statements. So I want at least 3 years, but preferably 10 years of profit and revenue history. And preferably, I want to see profit and revenue growing through time. Doesn't have to go up in a straight line, but I want to see some sort of growth there. Then the next thing I do look at is valuation metrics. PE ratio, price to sales ratio, and price to operating cash flow are my favorite. But you can look at also price to free cash flow, those sort of things. But I want to understand what the current valuation of those companies are right now. And then I want to compare the current valuations of those companies, of the company right now, compared to historical valuations of the company over the past 10 years. So if the PE ratio right now of the company is 15, and historically the PE ratio of the company is usually between say 20 and 30, if the PE ratio right now is 15, that could be telling us that the value of the company is really good right now. So I want to know the current value of a company right now and compare it to those historical valuations. Also do a reverse DCF. So what is the growth needed in either earnings per share or free cash flow to justify the current value of the company? So I don't usually do DCFs, but I really like reverse DCFs because that tells you what the growth of the company has to be to justify the current valuation. That is how I treat high quality companies. It's all about value. If I think there is good value in a high quality company, I will buy into that company no matter the trend in the share price, no matter the sentiment in the company at that point in time. It's all about value, not about trend or sentiment, which is a little bit different than low quality companies. For low quality companies, I don't really care about valuation. It's all about trend in the share price. It's all about sentiment, because sentiment in low quality companies is going to be the thing that drives the share price higher or lower. And that means I'm always going to be looking at charts for low quality companies. And this is a perfect chart that shows you what happens to a share price of a low quality company. This is a coal company, Whitehaven. And this goes back all the way to 2008. And you can see trends are very important for these type of companies. So there's about 5 trends here. Back in 2009 to 2011, the trend was up. Then it turned around for about 3 or 4 years. Then it turned up for about 2 or 3 years. Then it turned down for about 2 or 3 years. And now we are seeing the trend up. And that trend has been going up for about 2 years. So more than likely, this trend will store and stop and then reverse. And for the next 2 or 3 years after this trend stops, the share price of Whitehaven coal will go down because the underlying commodity, coal, will go down. So again, for low quality companies like mining companies, trend is your friend and sentiment is highly important. And the underlying commodity price is really important as well. So some investors I do know will actually, instead of following the share price of mining companies, they will follow the underlying commodity prices instead. That's all I have on this video, looking at the quality of the company and how I treat high quality companies a little bit different to low quality companies. If you want any further explanations of what I do, just leave your questions, your thoughts, your opinions in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.